Welcome to the advisory group's webinar on Social Security and long-term care. Thank you for attending. Let's first start with some introductions. My name is Will Glenn, and I'm a member of the tag team at the advisory group. Also joining me is Brent Beverly, the president of the advisory group, Chris Lee, the vice president, and Manny Chinche, a senior advisor. All three of them are certified financial planner practitioners and the top advisors at our Diamond Bar branch. If you have questions you want to ask, please reach out to us and we will try to address your question as effectively as possible. At the end, we have our contact information so you can reach us easily. These are the subjects we're going to be covering today. First, we're going to be taking Social Security, and next we're going to be exploring long-term care. Let's start with Social Security. Why do so many people collect benefits as soon as they can, at a reduced amount? For many, it's because they have to. They need the income to meet their needs in retirement. However, many of those who don't have this necessity still elect to take benefits early. Why? They may worry about dying too young and forfeiting the money they paid into the program. But Social Security's calculations indicate for men and women who attain age 65, life expectancy is 84 years old and 87 years old, respectively. If you can afford to wait until full retirement age or beyond, you should take a closer look at your options. Claiming benefits at the soonest possible opportunity may not be in your best interest. You may want to wait until you're age 70, or sometime earlier that best fits your family's situation. There are strategies you can use now that may help you maximize the benefits you will receive for the rest of your life, should you be fortunate enough to outlive your life expectancy. Social Security was never meant to replace 100% of our pre-retirement income. So how much does it replace? This varies depending on your earnings level and when you choose to retire. As an example, let's look at someone who starts their benefits at age 67. For anyone born in 1960, age 67 is your full retirement age, or FRA. If you were born before that year, you may qualify at an earlier age. We'll review that in more detail in a minute. Someone starting benefits at age 67 will find very low earners can expect their Social Security benefits to replace as much as 75% of their pre-retirement income. Medium earners can expect about 40%, and the high earners can only expect about 27%. Here we highlight 5 key risks in retirement and how Social Security can help mitigate those risks. Longevity. Social Security provides an income stream a retiree or spouse cannot outlive. Inflation. Benefits are typically adjusted on an annual basis to account for cost of living increases. Markets. Benefits are not affected by volatility in markets. Taxes. For retirees at lower income levels, Social Security benefits may be tax-free. Even for the highest income households, 15% of benefits will be tax-free, meaning that a maximum of 85% of benefits are taxable. And lastly, income. Social Security provides a regular guaranteed stream of income. This is especially important for retirees who do not have pensions. To further delve into Social Security, let me turn it over to Manny Chinche. Manny?
Thank you, Will. So let's first review some of the fundamentals of Social Security. By the way, SSA.gov is a great resource online. Eligibility. When you work and pay Social Security taxes, you earn credits towards your Social Security benefits. Now, the number of credits you need to get retirement benefits depends on when you were born. If you were born in 1929 or later, you need 40 credits, and that is equivalent to 10 years of work. Now, through the Social Security payroll tax, which is currently 6.2%, workers fund their Social Security. Now, note that employers also pay the same amount into the Social Security system, so the total there is 12.4% of your salary. Now, payroll contributions top out once an employee reaches the maximum compensation subject to Social Security taxes each year, which happens to be $147,000 for 2022. Social Security benefits are based on your lifetime earnings. Your actual earnings are adjusted or indexed to account for changes in average wages since the year the earnings were received. Then Social Security calculates your average indexed monthly earnings during the 35 years in which you earned the most. Now, we apply a formula to these earnings and arrive at your basic benefit, which is also known as your primary insurance amount. Spousal benefits. Now, even if your spouse has never worked under Social Security, he or she may be able to get benefits if he or she is at least 62 years of age and you yourself are receiving or eligible for retirement benefits. Now, a spouse receives 1/2 of the retired worker's full benefit unless the spouse begins collecting benefits before full retirement age. And if that were to happen, the amount of the spouse's benefit is reduced permanently by a percentage based on the number of months before he or she reaches their full retirement age. Additionally, there are survivor benefits as well. Your widow or widower may receive reduced benefits as early as age 60, full benefits at their full retirement age or older, or benefits as early as age 50 if he or she is disabled and their disability started before or within 7 years of your death. Now, is this complicated enough for everyone? We never said this would be easy. You'll hear this time and time again. Be sure to work with your advisor before making any final decisions on this very pivotal topic. As you approach retirement, when to claim your Social Security retirement benefit is one of the biggest financial decisions you'll ever need to make. Now, should you begin receiving benefits at your full retirement age, which again ranges from ages 66 to 67 depending on the year of their birth? Should you begin receiving a smaller monthly benefit before your full retirement age, as early as age 62? Or should you wait past full retirement age to receive an even larger monthly benefit? Now, you may delay receiving benefits up to age 70, at which point benefits are maxed out. Now, we have not yet found a reason to delay taking your Social Security benefits any later than your 70th birthday. As important as your decision is, there's no one-size-fits-all answer. It's a personal decision that must be made based on your unique circumstances. Of course, sometimes the answer is very simple. You might have to claim Social Security benefits as early as possible if you need Social Security income right away to meet your day-to-day living expenses, perhaps because of illnesses, disability, or unemployment. But if that's not the case, if you have other sources of retirement income or you want to continue working, for example, you'll want to take the time to make an informed, well-reasoned decision about your Social Security benefits. Now, if you're like most people, you've paid into Social Security system for years and you'd like to get the most out of it that you can. So to start, here are two major reasons why when you claim Social Security is so important. First, when you claim benefits can significantly affect your overall retirement income. With pensions just about disappearing, Social Security remains the major source of guaranteed lifetime retirement income for most Americans. Once you apply, your retirement benefit will be locked in for the remainder of your life. In most circumstances, not counting annual inflation adjustments or recalculations to account for additional work. So taking time to explore your options now can help you make sure you have enough retirement income later. Now, the timing of benefits can also affect your spouse because he or she may be entitled to receive spousal retirement benefits and survivor benefits based on the amount that you lock in and receive. Now, there's a lot to consider as you make this decision. As we previously mentioned, here are some of the factors that this presentation will discuss. Your full retirement age and how your benefit is calculated. The amount of your future retirement benefit and the effect of taking benefits early or late. How many years you expect to spend in retirement based on your health and your life expectancy. Whether you plan to continue working. Your other retirement income sources. Your income tax picture. And finally, how your decision will affect your spouse and the benefits that he or she may receive. Now, before we get into details, let's quickly go over two terms that you'll need to know. Now, the first term that we already mentioned is your full retirement age, commonly known as FRA. Now, we'll tell you how to find this in a moment. The other term you'll hear a lot is primary insurance amount, your PIA. Now, this is a calculation by the Social Security Administration that represents the amount you would receive monthly if you started taking benefits at your full retirement age, FRA. Now, both of these terms are used as starting points for calculating reductions or increases in benefits. Simply put, you'll receive 100% of your PIA if you file your FRA, but we'll get into that later. Now, in order for the remaining slides of the presentation to make much sense, you'll need to remember these terms, FRA and PIA. So let's start with two basic things you need to know as you begin to explore your options. Now, first, what is your full retirement age? That FRA that we've been mentioning. It's the age at which you can receive a full or unreduced Social Security retirement benefit. Your full retirement age, once again, ranges from 66 to 67, depending on the year you were born, as shown on the chart on your screen. Now, to put this chart in perspective, people who were born in 1957 are turning age 65 this year. So check your birth year to see when you reach full retirement age. Now, if you begin receiving benefits earlier than your full retirement age, you'll receive a reduced benefit. If you receive benefits after this age, you'll receive a higher benefit because you will earn delayed retirement credits. Now, other benefits that you or your family members may receive are also based on what you're eligible to receive at your full retirement age. Now, the second thing you'll want to understand is how your full retirement benefit is calculated. Now, the benefit calculation is complicated and beyond the scope of this presentation, but here's a brief overview. This chart shows the range of monthly benefits you may receive at different years. Now, in our example, we assume your full retirement age at FRA of age 66 is $1,800. There you see it right there in the middle. Now, depending on when you choose to begin receiving benefits, your income will change for the rest of your life, up or down. Now, your benefit is reduced by a certain percentage for each month you receive benefits earlier than your FRA. Now, if your full retirement age is 66, this equates to a 25% reduction if you were to take it at age 62. If your full retirement age is 67, this equates to a 30% reduction. However, if you delay receiving Social Security benefits, you'll receive delayed retirement credits that will permanently increase your benefit. Your benefit will increase for each month you delay receiving benefits, comes out to 8% per year past your full retirement age up until age 70. Now, note that we're only talking about benefits based on your own earnings record. So, in our hypothetical example, if $1,800 is the full retirement benefit at age 66, the monthly benefit of $2,376, the max, at age 70 is 76% more than the monthly benefit of $1,350 taken at the other opposite, age 62. A big increase. However, what this chart doesn't show is that you'll receive benefits for 8 years longer if you claim them at age 62 rather than at age 70, and that can add up to a lot of money over the years. Now, in this example, if you receive $1,350 benefit for 8 years, you would have received $129,600 by the age of 70, which of course doesn't even include cost of living adjustments. So we return to the fundamental question. Is it better to opt for a smaller monthly benefit at age 62, but receive it for a longer period of time, or is it better to claim at age 70 to receive the highest monthly benefit possible? Again, there's no one-size-fits-all answer. In part, it depends on how long you can afford to delay receiving benefits and on how long you expect retirement to last. Being financial guys, we of course take the analytical approach to this question. When is your crossover point? Now, this graph there on your screen shows a hypothetical example of the points when the total benefits received when taken at a certain age break even with the totals received when taken at another age. Now, as you can see, the later you take benefits, the greater the benefit amount will be when you get older. On the other hand, you'll have more benefits early in your retirement if you elect to take them early. How long you expect to live is one of the most prominent factors when deciding when to file. Now, the Social Security Administration says that for an adult at age 65, the average life expectancy is 84 for men and 87 for women. On top of that, Social Security says 1 out of 4 65-year-olds will live past 90, and 1 out of 10 live past 95. So remember, your lifespan may require a longer lasting income stream than you thought. It's important to consider this when deciding when to begin benefits. So in this example, if you plan to live longer than age 82 and a half, you will bring in more money for the rest of your life by waiting until age 70, if possible, to take your Social Security benefits. Now, to make this easier to view, this chart uses a hypothetical full retirement age of $1,000 per month. Now, we want to point out that the ages would stay the same under these assumptions, regardless of the actual FRA used. Of course, this is a hypothetical example. There are a lot of assumptions being used, so you would want to do this calculation based on your own conditions and make sure your strategy reflects your unique situation. Above the amounts that you can receive at different ages, there are several other factors to take into consideration when deciding when to begin your Social Security benefits. Now, some of these are your health, your marital status, lifestyle expectations, other assets that you may have, and how many years you've been working. Now, remember to consider these and other aspects carefully because they're a crucial part of your retirement plan. So let's take a deeper look at how these factors may affect your decision. These strategies are much more significant to you now than they were to other generations. Why? Now, longevity is a reality. It's important to the success of your retirement plan that you appreciate this factor. According to a Social Security Administration report, 1 out of 4 adults 65 today will live past 90, and 1 in 10 will live past 95. We mentioned that earlier. If you're married, you'll need to consider the joint life expectancies of both you and your spouse, which will often differ from your individual life expectancies. I'm sure many of you are aware that medical advances and healthier lifestyles have increased longevity over the years. So let's look at the bottom of this graph. A couple who reaches 65 has a 50% chance to living into their early 90s and 25% chance of living into their late 90s. So we can assume from these statistics, one person from a couple will live into their 90s. However, many people are not taking longevity into account when taking their benefits. Now, if you're thinking about working well into your 60s and 70s to increase your retirement savings, you may be wondering whether you may receive your Social Security benefits while you continue to work. The answer is yes. Many people choose to apply for Social Security benefits before they actually retire. But as you may have heard, earnings from work may affect your Social Security benefit if you're under full retirement age. So if you're under full retirement age and your earnings exceed a certain amount, called the annual earnings limit, part of your benefits will be withheld, reducing the amount you receive from Social Security. But once you reach full retirement age, you can work and collect full Social Security benefits. Earnings from a job will not impact your benefit at all. Now, if you're under full retirement age, the rule is that $1 in benefits will be withheld for every $2 you earn over the annual earnings limit. Now, this limit generally changes every year. In 2022, the limit is $19,560. In the year you reach full retirement age, a special rule applies. $1 in benefits will be withheld for every $3 you earn over the annual earnings limit. In 2022, this limit is $51,960. And as mentioned earlier, at or after full retirement age, month specific, earnings will not affect your benefit. However, to clear up a common misconception, you're not actually losing your benefits because you choose to work, so you don't need to try to limit your earnings. If some of your benefits are withheld, you'll receive a higher monthly benefit at your full retirement age. It'll keep building because the Social Security Administration will recalculate your benefit every year and give you credit for any of those earnings that are withheld. So the effect working will have on your benefits is only temporary, and any additional earnings you have may actually increase your benefit later. Now, the Social Security Administration website has a tool called the Retirement Earnings Test Calculator that you can use to see how earnings before retirement age may affect your benefit. For retirees with moderate or higher income, there's a good chance that at least some portion of their Social Security benefits will be included as taxable income. Now, there are 2 different income thresholds for determining taxation of benefits. The income calculation, known as combined income, includes your adjusted gross income, your AGI, Added to that your non-taxable interest, such as municipal bond interest. Added to that 1/2 of your Social Security benefits. That formula comes out to your combined income. Now there on your screen, you see the levels that will subject you to taxation. For example, if that combined income total is $36,000 for a couple, we know that 50% of Social Security benefits will be taxable. Now, to clear a common misconception, taxable is far different than taxed. People figure 50% of their Social Security will go to taxes, which is not the case. 50% of Social Security would be subject to taxes at whatever your tax rate or tax bracket ends up being. The other 50% is absolved completely free of taxation. So if you're married, there's another important question you'll need to ask before you decide when to claim benefits. How will my decision affect my spouse? That's because when you begin receiving your retirement benefit can dramatically affect your spouse's benefit during retirement, and that's your household income. And your decision can also affect any survivor benefit your spouse may be entitled to, and your spouse has decisions to make as well. Now together, you'll need to consider what the most appropriate combination of claiming ages is based on your ages, earnings, and life expectancies. Other people, such as your dependent children or even a former spouse, may also be eligible for benefits based on your earnings record. But the rules are a bit different and they are not covered in this presentation. We're happy to go over that with you privately. Now, there are many complexities associated with these benefits, so it's necessary to plan properly. Now, here on your screen are a few general rules to consider. If you file for spousal benefits at your full retirement age, spousal benefit will be equal to 50% of your spouse's PIA. Now, you must be 62 years or older to qualify. You cannot collect benefits on current spouse's record until he or she files for their own benefit. Your amount is reduced if taken before full retirement age, but will not increase if delayed. And finally, these rules also applied for divorced spouse benefits, as long as the marriage lasted at least 10 years and the beneficiary spouse is currently unmarried. In addition to retirement benefits and spousal benefits, married couples must consider survivor benefits. When you claim your Social Security benefit can greatly affect the amount of income available to your spouse should you die, because your surviving spouse will generally receive the benefit that you were receiving at the time of your death, unless your spouse is already receiving a higher benefit based on his or her own earnings record. Now, if your spouse's life expectancy is much longer than yours, this can be an especially important consideration. Survivor benefits may be payable as early as age 60. However, a benefit reduction will apply if the surviving spouse begins collecting a survivor benefit between age 60 and his or her full retirement age. Now, here on your screen is a hypothetical example that illustrates why it's important for spouses to carefully choose when to begin receiving Social Security retirement benefits. In this example, both spouses are able to claim benefits based on their own records. Spousal benefits are not even considered. As this table shows, if both spouses choose to claim benefits at age 62, their joint monthly income will be $2,784. But if both spouses wait until age 70, their joint monthly income will increase to $5,241. That's a difference of $2,457 per month, which comes out to almost $30,000 per year. Now, in addition, by waiting longer to claim retirement benefits, spouse 1 may also substantially increase spouses 2's monthly survivor benefit, since Social Security generally pays a surviving spouse the larger of his or her own retirement benefit or the benefit his or her spouse had been receiving. Of course, this illustration does not take into account the other factors that this hypothetical couple may need to consider, and your own situation and overall income plan will be unique. So first, let's address the question that seems to be on everybody's mind, and certainly on our minds. Will Social Security be there when I need it? Now, there's a lot of information out there today telling you the system is insolvent, broken, or even worse. Though most would probably agree that concerns about the program's sustainability are legitimate, the controversy has created some misconceptions. Each year, we send out a summary of the Social Security Trustees report. Now, it's a good idea to take a quick look at some information from the program's trustees who publish this exhaustive report every single year. So if you haven't read our summary, we recommend doing so. It's in our website. Now, in addition to the summary, we've also posted the actual Social Security Trustees report. Now, here's some of the report's findings. According to the 2021 Social Security Trustee Report, 2021 was an unusually good year for Social Security. Low unemployment leads to more funds coming in and fewer funds going out. There you see on your screen, $1.088 trillion in income compared to $1.145 trillion in expenses. Now, the balance in the OASDI trust fund stood at $2.852 trillion. 65 million Americans were receiving benefits, and 175 million people were contributing into Social Security. So 2020 was a crossover point where expenses in the program, primarily benefit payments, began to exceed income generated from contributions and interest for the first time in many years. Unchecked, this will lead to the program becoming insolvent around 2034 or 2035. Important note, this does not mean the Social Security will end, but it does mean that benefits are likely to be seriously reduced. Now, the current projection is that benefits would be reduced 22% across the board starting in 2034. And we've seen figures that indicate a benefit reduction of 20 to 25% occurring anytime between 2032 and 2035. Now, the projected insolvency of Social Security is not something new. The program is historically set up as a pay-as-you-go system that was not entirely feasible with a change in economic and demographic trends of our nation. In the 1970s, the Social Security Board of Trustees predicted short-term and long-term financial problems for the system. And here on your screen are some of the measures that the Social Security Administration and the federal government may be able to take to fix things. An increase of Social Security tax rates. Higher maximum of earnings subject to that Social Security tax that we talked about earlier as being $147,000 for 2022. Increasing the full retirement age, likely for the younger generations. A decrease of future retirement benefits. And finally, a reduction of the future cost of living adjustments, the COLAs. Now, Congress addressed these issues previously with the passage of the 1977 amendments, which included provisions to increase the tax rate, increasing the earnings base as well as reconfiguring the benefit formula, but it was not enough. Now, by the early 1980s, Social Security again faced a similar serious financing crisis. A law passed in 1983 made numerous additional changes, including taxation of benefits, raising the retirement age, and increasing the reserves in the trust funds. Now, with the passing of these 1983 amendments, the financing problems of the late 70s and early 80s were temporarily resolved and pushed out to the mid-2030s. Now, we can only hope that sometime in the near future, our politicians are able to do that again. Now, this presentation has explored some of the major questions that you'll want to consider as you decide when to begin receiving Social Security benefits. To recap, here are some of the reasons you may decide to claim benefits earlier, as well as some of the reasons why you may decide to claim benefits later. Remember, the choice really is yours. It's up to you and with our guidance based on your unique needs and circumstances. Now, retirement can be an exciting time, but with it comes financial challenges. And when you're ready to make decisions about your Social Security benefits, take time to explore your options. Now, we've covered a lot of Social Security information here. So what should you do? As a starting point, if you haven't already done so, we urge you to go to the Social Security website. We have the link on our TAG website under resources/TAG web resources. Now, the Social Security website provides you with a couple of relatively easy ways to estimate what retirement benefits you may receive. First, you can sign up to access your Social Security statement online so that you can view your actual earnings record and what you can expect to receive under current law if you were to apply at age 62, at your full retirement age, and finally at age 70 where you max it out. And if you're already age 60, you also have the option of receiving the statement in the mail every year, about 3 months before your birthday. One important note, be sure to check your actual earnings record to make sure they have the correct information. If you find that your record has a year which is not accurate, it is generally easier to get that fixed sooner rather than later. Now, the second way to estimate your Social Security benefit is to use the Social Security Administration's Retirement Estimator, which is also available at their website. This calculator allows you to input various scenarios based on current law to estimate your future benefits. And as you near age 62, you should also contact the Social Security Administration to discuss your options. Representatives are not allowed to give you advice about when to start your benefits, but they'll be happy to explain your options and the rules that apply. And when it comes time to apply for Social Security benefits, you've made that decision. You can do so online, by phone, or in person. Now let's switch gears here and look up at another major concern of anyone near retirement, that being long-term care. So to get us started on this vital subject, allow me to introduce Chris Lee. Chris?
Thank you, Manny. Long-term care is another possibly complicated yet very important subject. Let's begin by talking about what is meant by the phrase long-term care. Long-term care refers to the ongoing services and support needed by people suffering from chronic health conditions or disabilities. Let's clarify this a bit. As you get older, do you think you will need help getting up and down? Do you think it may be harder for you to do many of the everyday activities that you do today? If so, you may need additional care. There are 3 levels of ongoing care someone might receive. The first level of care is skilled care, which is generally round-the-clock care provided by professional healthcare providers such as nurses, therapists, or aides under a doctor's supervision. The next level of care is intermediate care, which is also provided by professional healthcare providers, but on a less frequent basis than skilled care. The third level of care is custodial or personal care, which is often provided by family caregivers such as nurses, aides, home health workers, who provide assistance with what we call activities of daily living, such as bathing, eating, and dressing. This is the most common type of long-term care. All 3 levels of care may be provided in many different settings, including your home, an assisted living facility, or a nursing home. A long-term care plan is usually made up of different pieces, with many people involved in putting it together. A good long-term care strategy will account for the different types of care you might need and the different settings in which you may someday receive them. How many people listening to this expect to need long-term care one day? It's not surprising that few of us do, because it's hard to face the fact that our health may decline. But statistics suggest that the risk is greater than we think. Approximately 70% of us, that's 7 out of 10 people listening today, will need some type of long-term care service during their lifetimes at some point after they reach age 65. And though it's good news that people are living longer, a longer lifespan increases the chance of developing serious health problems. In fact, according to the Alzheimer's Association, approximately 14% of people aged 71 and older have Alzheimer's disease, which often leads to the need for nursing home care. 1 in 3 Americans die with Alzheimer's or some other form of dementia. And while older people are more likely to need long-term care, younger people may need care too, as a result of a disabling accident or illness such as multiple sclerosis or Parkinson's disease. This isn't meant to scare you, but rather to remind you that the need for long-term care can happen to anyone at any time. The need to be prepared is real and something that you shouldn't ignore. Why is this a concern now and not for earlier generations? The key reason is that people are living longer and healthier lives than at any time in history. People who retired 50 years ago had a simple retirement plan. They would typically work until age 60 or 65, collect a gold watch, and then they would move in and live with their kids for a few years until they died. In case you hadn't noticed, that's not how retirement works these days. There's no way to know for sure, but your retirement may last longer than you think. We spoke earlier about the Social Security Life Expectancy Report that stated that, on average, a man who reaches age 65 can expect to live until approximately 84, while a woman who reaches age 65 can expect to live until approximately age 87. If you're healthy and affluent, you are more likely to live even longer than the average. Also, according to Social Security Administration, about 1 out of every 4 retirees will live past age 90, with 1 out of every 10 living past age 95. So you may even want to plan for a maximum lifespan to reduce the risk that you'll live longer than you expect. If you're married, you'll need to consider the joint life expectancies of you and your spouse, which will often differ from your individual life expectancies. With all the new miracles of modern medicine, we expect that ever more and more people will be living longer and healthier lives. What used to kill us quickly now is treatable, allowing longer lives. Unfortunately, as we age, parts of our body simply begin to wear out. Has anyone ever noticed that you don't stand up or sit down so quickly as you did 10 and 20 years ago?
This is Brent. I want to slide in here for just a couple of minutes. This section was not a part of our original presentation, but we saw this new information come in and I want to share it with you because I believe it is very important to all of us. Now, as you know, we at the advisory group like to look for trends that are coming down the road, especially demographic trends. And we're at the beginning of what looks to be a massive trend, and we believe everyone should be aware of this. So what is going on here? The chart is actually a measure of the risks that Americans face from incapacity as they age, specifically their risk for debilitating problems such as Alzheimer's, other kinds of dementia, or mild cognitive impairment, what we call MCI. Now, according to Mr. Grisham, who wrote this in an article, and let me quote him here, currently 1 in 8 people at age 68 will suffer from one of these illnesses. That figure more than doubles by the time they reach 78, and it increases 6-fold by the time they're 88. Over the next 10 years, nearly 1 in 3 people that we now serve is likely to become incapacitated, and a great many more will be affected when someone in their life does this. Now he continues, we will also have to be there for perhaps 3 generations of family members affected by their aging parents or grandparents' new reality. When we talk about long-term care, I think you'll agree that these numbers are staggering. So let me turn this back to Chris.
The need is obvious and a little scary. Let's talk a little bit more about where you might receive care. You're probably already familiar with some of these options. If you want to stay in your home for as long as possible, that's certainly an option, even under a long-term health event. Often, family caregivers, friends, and trained homemakers provide the bulk of the assistance with everyday tasks, and professionals such as nurses, therapists, and home health aides provide occasional home health care. Some folks want to stay in their homes with full-time care. This can be an expensive option. Another long-term care option that has become very popular is adult daycare facilities, which are community-based centers that provide healthcare and social services for people who can't be left alone. Often, adult daycare facilities specialize in caring for people with Alzheimer's disease, and they are especially beneficial to family caregivers by providing them a few hours of much-needed respite care during working hours or on the weekends. The third option is assisted living. How many of you have ever visited an assisted living facility? If you have, then you know that these are usually home-like facilities that combine housing, personal assistance, and limited health care. Generally, assisted living facilities offer intermediate and custodial care around the clock, but not the skilled care a nursing home provides. This option may be ideal for someone who can't continue to live alone but wants to remain independent. The last option, nursing homes, generally offer all three levels of care: skilled care, intermediate care, and personal care. Most nursing home residents have disabling illnesses, including cognitive disorders such as Alzheimer's disease, that are so serious that these individuals cannot be adequately cared for anywhere else. According to healthandaging.org, 15% of people age 85 and over live in nursing homes, with nearly half needing help with everyday activities. If you haven't already done so, I urge you to visit some of the facilities available in your community so that you get an idea of what long-term care services will be available to you and your family members. As you might suspect, the nicer places tend to cost more. I want to note the idea of respite care. Respite care is where caregivers get some time away to take care of the rest of their lives. If you are the caregiver, you need a break, especially if you're giving care 24/7. We have one client recently who needed to care for a parent. Because of the parent's condition, they needed to be within 5 feet of the parent at all times. It was stressful for everyone involved. We will talk more about this in a few minutes. Let's look at what the government is doing now to help people with long-term care needs. There are 2 programs available, Medicare and Medicaid, also known as Medi-Cal in California. So let's take a quick look at these 2 programs. Most of us have some familiarity with Medicare. Medicare is designed to provide medical insurance supplements for Americans age 65 and over. While this is really medical coverage, there are some provisions within Medicare to take care of long-term care needs. In order to have Medicare pay for long-term care, there are some strict restrictions. You must have been in the hospital for 3 consecutive days. You must enter an approved facility for the same condition for which you were in the hospital within 90 days. And the doctor must certify that you need daily skilled care. Note that term, skilled care. Medicare does not cover intermediate or custodial care. Remember that Medicare is designed to be medical insurance, not long-term care insurance. It is designed to fix you and move you on your way, not take care of you long-term. Care must be rehabilitative in nature. If you meet Medicare's requirements, Medicare will pay all reasonable and customary charges for the first 20 days. For the next 80 days, there is a co-payment of $194.50. At the 101st day and beyond, you're on your own. Let's now look at Medicaid. This is the name of the program designed to take care of people who financially cannot take care of themselves. Here in California, we call it Medi-Cal. So while the program is funded by the federal government, it is run by the state. It's a government program for the needy. Clients must spend down their assets to qualify. There's a 30 to 60 month look-back period, and not all nursing homes accept Medi-Cal. There's a constant battle going on with more people trying to find new ways to, quote, game the system, and the regulators finding ways to ensure that people who can pay take care of their fair share of cost. We have seen people putting their homes into irrevocable trusts, people who have moved all their assets into annuities, other people who tried to transfer all their assets to their kids or other family members. All kinds of games to get the government to pay for their care while not using their own assets. Because the government can change the rules whenever it feels it's necessary, the government usually wins. You see that look-back period there on the screen? Every state has a 60-month look-back period that allows the government to look back at your level of assets going back 5 years. Every state except California, that is, which is a little bit more lenient with a 30-month look-back period, meaning that they're going to go back and look at the last 2.5 years. If you're tempted to use any of these qualification exceptions or concepts, be sure to have a specialist guide you. This is too complex for us at the advisory group. The rules simply change too often and so drastically that we don't feel competent to make recommendations in this area. The financial demands of long-term care have other concerns for us. How will your spouse take care of himself or herself? If one spouse needs long-term care, will they leave a healthy spouse but an impoverished spouse? If both spouses need long-term care simultaneously, who will arrange for the care? Who will supervise the caregiver? If you're single, who will arrange for your care and who will supervise your caregivers? To discuss ways of paying for long-term care, let me introduce Mr. Brent Beverly.
Thank you, Chris. We've discussed why most of us will have a need for long-term care, but what are the costs of that care? The cost of care continues to go up. This year, according to Consumer Affairs, the median annual cost of a nursing home is between $86,000 and $150,000 per year. At an assisted living facility, the average cost is $51,600, and the average cost of a full-time in-home care is $43.85 per month. Now, this is a national average. You can imagine that in areas such as Orange County or LA County, the costs are going to be on the higher end of the range and far higher than the average. Our experience has been that the cost for full-time in-home care in our area is more than 3 times the number here, or about $15,000 per month. Fortunately, or unfortunately, depending on how you look at it, people who are healthy and rich tend to live longer and hence have a greater need for long-term care. If you need long-term care and you have more than the government limits in net worth or income, well, where are you going to get the money to pay for your care or that of your parents? Will it come from savings, investments, retirement accounts with the tax consequences, pension, which you may or may not control, getting it from family members, reverse mortgage, insurance, Now, we find that most people, especially those who have not planned for long-term care, start as private payers, that is, paying from their own pockets. And when they use up all of their resources, then they end up turning to the government for financial assistance. In addition to the costs paid by the care receiver, there are also the costs paid by the care giver, typically your family, but often others who are taking care of you. 83% of caregivers also contributed financially to the cost of care. Very high number, 83%. Plainly put, self-insuring means paying for your own care out of your own funds. And this is the default program. Spend your money until you run out. But if you happen to never need long-term care, well, this would be the right decision. But as in all types of serious expenses, we acquire peace of mind by exploring ways to protect our hard-earned assets. One way to help pay for that care is the same way we handle other potential disasters in our lives, and that's insurance. So just as you may have homeowners insurance, auto insurance, medical insurance, umbrella liability insurance, life insurance, well, you can help protect your family by having long-term care insurance. Now, there are two fundamental kinds of long-term care insurance: traditional long-term care insurance, or what we call a hybrid policy. So let's explore how these work. Let's explore the rules so you know what to look for. When you have insurance to cover your long-term care needs, the policies typically use federal guidelines to determine the triggers for long-term care benefits. Once you meet the triggers, then the insurance will begin paying the benefits under the terms of the policy, usually for much more than just helping with the triggering activities. So these guidelines are usually used for both traditional long-term care policies and the hybrid policies with additional long-term care benefits. So we've ordered these to make them easier to remember. B, C, D, E, T, T. So the federal guidelines requiring assistance typically require 2 out of 6 of these activities of daily living, these ADLs, to qualify for benefits. So the first one, B, stands for bathing. That's being able to wash yourself without assistance. Continence, being able to hold it in fore and aft, one way to say it, or control your bladder and your bowels. So dressing, being able to dress yourself without assistance. Eating, can you feed yourself? Now this is much easier than you might expect. It's simply, can you take the food from the plate and put it in your mouth unassisted? It does not include preparing the food or other things like that. The first T stands for toileting, being able to use the bathroom without assistance. And then the final T is transferring. Now, this one means basically being able to get out of the bed, across the room, sit in a chair, get out of the chair, back across the room, and get back in bed all on your own. Now, in addition, you can usually qualify for benefits through cognitive impairment. Now, most people think of this as Alzheimer's, but there are other forms of dementia that also qualify. Just last year, an acquaintance of ours had a stroke and will never quite be the same mentally. Unfortunately, the family had no long-term care coverage, and it's tearing up the whole family, the wife, the children, their business, etc. If you meet the trigger conditions, if you meet 2 out of the 6 ADLs or the cognitive impairment, then the insurance will begin to provide benefits. Now, some policies have what's called an elimination period. During this benefit, you qualify for the benefits, but the insurance company will not pay until the end of the elimination period. And we see elimination periods of 0 days, 10 days, 30 days, 60 days, 90 days, or more. And it's important to check the elimination period on any policy that you might want. Some of these use days that you actually receive treatment. Other ones use calendar days. So there's some important distinctions on this, particularly where we look at the elimination period. Now, once you've triggered the benefits, you're not limited to just care in those 6 items. All right? Other expenses are also available for reimbursement. And these other activities are called Instrumental Activities of Daily Living, IADLs. Now, I didn't invent these terms, they're from the government, but that's exactly what they are. IADLs are not necessarily for the fundamental functioning, but they let an individual live independently or in a community. They include, but are not limited to, the activities such as the ones listed here: housework, managing your money, taking your medications, preparing and cleaning up after meals, shopping for groceries or clothes, using the telephone or other communications devices, caring for your pets, responding to emergency alerts such as fire alarms and things like that. So as you can tell, there are a lot of other activities which are covered other than just taking care of you personally. When we look at long-term care coverage, you'll want a plan that provides the broadest coverage at a price you can afford. Now, policies can vary widely, so it's important to make sure that any policies you're looking at, any ones that you compare, you know what you've got. Now, although we can't cover everything today, what you should look at are these 5 key features to consider, all of which affect the premium that you will pay. First of all, you'll need to choose the benefit amount that will be payable should you need care. Now, this is calculated as a daily payment. This will giving you the maximum amount of the policy, and it may pay for each day or sometimes per month. So it's typically the ranges we see are from $50 to $350 per day. You'll also need to choose the benefit period. The benefit period is the length of time that your policy will pay long-term care benefits once you need care. Now, most benefit periods range from 1 year to 6 years, with some policies offering a lifetime benefit. Now, if you can't afford a lifetime benefit, you may want to choose a benefit period that coordinates with the look-back period for Medicaid, which is 5 years. So in other words, gee, I'm going to need care for a long time. You can start to transfer assets to other people. Well, if you do that, they'll look back 5 years and say, well, 5 years ago you transferred this away, or 4 years ago you transferred this away. We're not paying benefits until you've recovered that money. So what we're looking at. Now, we talked about elimination periods just a minute ago. So each policy lets you look at the elimination period, the number of days that you'll pay for your own care before benefits kick in. So again, we talked about it, typically 20 to 100 days, sometimes shorter, sometimes longer. We've seen benefit elimination periods of up to a year, oftentimes 180 days, but more normally 90, 60, or 30 days. Where you want to receive care in the future is another important consideration. Although you can purchase some bare bones policies that only cover nursing, actually in the nursing home costs, many policies, and I would say maybe most policies, will cover care in a variety of settings, including your home, the other things, your assisted living facility, an adult daycare center, nursing home, etc. You'll need to decide whether or not you want inflation protection. With inflation protection, your benefit increases by a certain percentage each year. Now, inflation protection can be an optional feature, and it can make your premium rise significantly. But it's especially important if you want to have your coverage keep pace with rising costs, and the younger you are, the more significant that is. So make a note of this. This feature is very important, but it's often overlooked. Now, each of these features can be set individually within a traditional long-term care policy. You can typically set these at whatever level fits you within certain limits. In a hybrid policy, you usually have little flexibility in setting these features. They're standardized by the policy. So a little less flexibility when you deal with the hybrid policies. Let's take a look at these hybrid or asset-based long-term care insurance. These policies look to leverage your existing funds to help pay for future long-term care expenses. Now, we find that clients often have assets just to make sure they don't run out of money in the future, or what they like to call, quote, just in case money. Even people with significant assets seem to have this lurking fear that somehow they'll lose their net worth and need some of their money to take care of their day-to-day expenses in the future. So what kind of assets are we talking about? You see them listed here: certificates of deposits, bonds, bank accounts, annuities, especially fixed annuities. Life insurance, particularly old cash value life insurance policies, work really well with this. And for those who qualify then, hybrid long-term care policies can leverage those funds to create a significant additional wealth. So this is what they do: provide liquid assets to provide for, to take care of, well, that access to principal should you need it, should something come up. They also provide principal protection, a guarantee that you can get all or a substantial portion of your money to use if you need it early. Or they also provide a certain rate of return. Okay, so if you just need the assets, these work well for you. But they also provide a legacy for their heirs if they don't need the funds themselves. This is a need we see all the time. If I don't need it, when I go, I'd like to take care of my heirs the best way I can. So how would you like to provide your heirs with a larger legacy than just what your CD is? Maybe 2 or 3 times as much. And finally, the key reason we're talking about this here is the assets can help you handle a potential need for long-term care. Just what we've been reviewing, they can provide the reimbursement for long-term care expenses, and we've seen that like 3 or 5 times as much money as you originally invested. A significant leveraging ability there. So by using this hybrid policy, we can improve your resources many-fold, whether you need the money yourself, whether you leave it for heirs, or whether you need it for long-term care. A hybrid policy can actually provide increased benefits in all these areas, what we call leveraging your assets. So again, using the funds in a CD as an example, well, you get to keep the benefits of the CD, the access to the principal protection, and the rate of return, while at the same time providing for an increased legacy to heirs or coverage for long-term care should those things come up. The actual benefits provided, of course, can vary widely depending on the company and the policy that you choose. So be sure to compare policies based on your personal situation. Be especially wary of policies that use the term chronic illness rider. All right, this is a common term, chronic illness rider. This is usually an indication that the policy is not really a long-term care policy. We think it wise to be guided by someone knowledgeable in this area whom you trust. So make sure your agent is properly licensed to provide long-term care services so they can share with you what the difference is. All of this said, having long-term care insurance may not necessarily be the best approach for everyone. So we look at it, we want what's best for you. So the premium should be less than 7% of your income. Your assets should be more than $100,000, not including your home. Your income through retirement should probably be more than $30,000 a year. And of course, you need to qualify medically. So you can't wait too long. You got to make sure that you're healthy enough to get good coverage. So what's next with this? Well, we're planners. Develop a plan to plan for your long-term care. Remember, there are only 3 options available. Government care, such as Medicaid or Medi-Cal, where you have to spend down your assets to make yourself and your family poor in order to qualify for benefits. Self-insure, use your own money. And finally, if it works for you, leverage your assets by using the insurance company's money. Whatever your plan is, have you shared it with your family so they know what to do should something come up? Have you written it down? We find that writing something down means that you have a better plan than just saying things like, my wife or my daughter, they'll take care of me. Or I'll find a way to die before I need care. I've actually heard people say that. Guys, when you get there, that isn't a plan. All right, and I think that you'll agree that these kind of plans are probably not the best plans to have. Long-term care is not an area where you probably have all the knowledge that you need. So here are some additional resources you should consult as you develop your plan of action. Now notice we put ourselves at the top, but hey, there are other folks that you can work with here, attorneys, family members. California has a couple of departments where they provide additional information, the Department of Aging and the Department of Insurance. So of course, we think we're your best resource, but check it out. Wow. I hope you've stuck with us to this point. It's been really complex. You probably have some questions on this. We gave you some resources to look at. If you have any questions, feel free to reach out to us. Here is our contact information, as well as some important disclosures and disclaimers here. So again, reach out to us, let us know that you saw the presentation, and we'll be happy to help you with any questions that you might have. Thank you very much for attending. Have a wonderful evening.